Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Derek Clifford. He is a multifamily real estate investor, a fund manager, and the host of 3 Degrees of Freedom podcast. He retired from his corporate job in September of 2021 and now controls over $50 million of assets under management and 400 plus apartment units through his company, Elevate Equity. His mission is to help corporate employees and self-employed entrepreneurs achieve the 3 degrees of freedom, being location, time, financial, 1 degree at a time by purchasing, improving, and operating cash flowing multifamily real estate in the Midwest and in the South. Derek is also the author of a book called Part-Time Real Estate Investing for Full-Time Professionals. And I know you and Sophie have been doing quite a bit of travel, so I definitely I'm going to want to dive into that as well, Derek. But welcome to The Wealth Flow.
Keith, it is a pleasure to be here, and I'm really looking forward to chatting with you today. It's been a while since we last spoke, and so this will be a really fun catch-up.
Yeah, it's been so long that Derek said, "Good to meet you." And yet we've shared dinner together, but it was 2 years ago, Derek.
Oh my God.
Yes. No, I'm messing with you. All right. Well, if we could, maybe, Derek, I always like to start from the beginning, kind of where you grew up and eventually what kind of led you to real estate.
Sure. Yeah, I don't want to spend too much time here, but I grew up in Los Angeles and then moved to Colorado, where my parents got sick of the traffic and the weather and all the stuff happening in SoCal. So we moved over to Colorado. Then I graduated as an engineer and went to work in Texas. And it was in Texas that I had met my wife. I was working in oil and gas, and we had some, mutual friends that were also in oil and gas. And after some time, I met her in Texas when she was coming home to see her family. Right, I was in Texas. She was in Washington State as a training to be a doctor at the time. So she was in med school, and we kind of hit it off and started dating long distance from Houston, and she's in Seattle. And so eventually, I transferred and moved to Seattle, or like the Bellingham area, which is within a drive of the Seattle area. And eventually we got married, which is always, that's the biggest success. I know we talk about successes here in real estate, but the real thing is the relationships. And my wife, I wouldn't be here talking with you today without my wife and all the things that she helped teach me. Not only the values, but also how important it is to think long term, the emphasis on health, and all the other things that kind of feed into being a really productive entrepreneur and someone who wants to add value, and also someone who invests in real estate. And our real estate investing journey kind of started in Washington because my wife had purchased a condo it was like 2 months before the 2008 meltdown. She had started med school at the time, right, in like 2006 or 2007, I think. And so she started med school, and when she purchased the condo, it was like $250,000 or something. And 6 months later or 3 months later, somewhere in that realm, it was like 90K. But there's this huge loan on it. There's a 200,000+ loan on the property. And so this property is like far underwater. So we ended up, I wasn't there for that, but by the time I did, I was there with her. She was getting ready to graduate, and the house, it still hasn't recovered all of its value. When we had it appraised, or we had an agent look at it, they said that maybe we could get 200K or maybe 175 for the condo, and we still had like a $225,000 mortgage on the thing, and so there was no real way that we're going to be able to sell it. So we ended up becoming landlords by default, and because we couldn't sell, so the only thing we could do is continue to hold on to it and then maybe rent it out to try to get some tenants to cover the mortgage and all the other things while we were away, because she got a residency offering in the Bay Area in California. So she went down to the Bay Area, and then there was no one there, at the condo anymore. So at the time, I was really big into Dave Ramsey, right? I was really trying to, save as much as I could so that I could have, a nest egg of $2 million so that I could live off of $80,000 a year, right? And just make that happen, because it's the rule of, what is it, 4%, is what Dave Ramsey said. And so I was trying to pay down loans, and at the same time, like, I was going through personal development because of my wife, and she was like, I read The Rich Dad Poor Dad, and I was like, man, there's got to be a way to get out of all this. And as we were driving from Washington down to California, right, to stay in our new rental apartment, we got our first rent check from our tenants. And when we got the rent check, I realized, so we were doing the math here, and it was like we were cash flowing $300-400 off of it, even after the mortgage, after a healthy amount for, like, maintenance and capital expenditures and all of that. No property manager, but we had all of those stuff, like, calculated out. That's when the light bulb went off. It's like, oh my gosh, like, we're cash flowing on this thing, and we have an asset that's increasing in value, right? And it's creating income for us, and we get a tax write-off. And I was just blown away. And at that point, like, I was like, talk to my wife, like, oh, in the car. It's like, if we did this on accident, can you imagine what would happen if we really tried and leaned into it and did it on purpose? And so at that, Keith, like, I went nutso and started, studying everything I could on Bigger Pockets. Like, I was listening to the podcast every day and catching myself up, and, on during my long commutes to the job. And so I did that for many years, like 4 years, I think. And we finally pulled the trigger on some single family homes, then started investing in out of state property, right, from California. And it was crazy. We got to a point where we were buying one property a month. And then we maxed out all of our loans. We maxed out the number of single family loans we got. Then we started doing joint ventures on multifamily, right? Which is another learning curve and a really hard property when we first got our first multifamily, which we still own. And then from that point forward, we, like, kept doing joint ventures, and then I ran out of money, right? So we ran out of loans first. Now I ran out of money. And then I learned syndication from a mentor. And then we kind of just took off from there. So, between 2015 and 2022, which was last year, the beginning of last year, we scaled from having one property to over 400. So in our portfolio, and so that's kind of that where that happened. It was very much of like a hockey stick type thing. When we started doing syndications, things got really quick. We started growing really, really quickly. So, yeah, that's a quick overview of who we are and how we got to where we are today.
Awesome. Yeah, no, great story. And so outside of the syndications, how many properties did you and Sophie buy together?
Yeah, so when we did single families, I think we had at least over, I think it was 13 or 14 properties, I think. And some of them were duplexes, some were triplexes and fourplexes. So we were at about like maybe 30 units or so. But by the time we ended up, liquidating everything and moving and 1031ing them into multifamily.
Okay, perfect. Okay, so you did exit those and went straight into multi. Um, and what are some of the differences, just for the audience? I mean, single family has some very nice characteristics, but so does multifamily. What's kind of the biggest difference that you feel between the two?
Yeah, with single families, um, there's you have to do everything like each property is its own entity, and so um there's one stream of income, there's one tenant, and there is one set of expenses, right, and a property manager for each single family home. You got to have one set of books, and it's just like that's usually the way that it is. But with multifamily, you can, with one closing, you can have 5 units, it can be 20 units, it can be 40 units, it can be 100 units. It's all the same thing. It's one closing, right? You just have to have the skill to be able to manage all of it, because you have 3 times the tenants, 20 times the tenants, and 20 times the maintenance expenses and all those things. So you have to have a good team to be able to prepare and have to be able to handle all of the busyness and the work that comes with it. So I'm sure you've heard this before, but it's the economies of scale that's the big difference. There's also the way that properties are valued and the way that loans work is different in the commercial space than it is in the single family space. And so it's much more business oriented in the commercial space. Like, you're looking at how much money the property is generating and what the total profit is, or the net operating income. That's going to determine how big your loan is, versus on single families, it's whatever the appraisal comes out to be. So it's very different. There's more control. There's more of like a systematic type approach that comes with the multifamily approach. And that's something that we really like, because if you can buy a 20 unit, then you can also buy an 80 unit, given you have, the same systems and procedures to be able to handle all of that activity. So that's the big difference between the two, in my
Yeah,
mind.
that's it, for sure. For sure. No, that's neat. And then as far as geographically, where all do you currently have apartments?
Yeah, so right now a bulk of our property is in the Midwest. It's in Indianapolis and then also Louisville. We really like those major metro areas, just because metro areas tend to draw people in. So we don't like to go too far out into the rural spots. We like to be in areas of high demand. And then, of course, we have a few properties in Austin and San Antonio also. But a bulk of our stuff is in Louisville and in Indianapolis.
Okay, fantastic. And as far as you've invested in these as syndications, and so you have in investors, and you talked a little bit about the net operating income. And, one of the beauties of multifamily is just, you can increase that and literally know what the value is going to be. It's not like you mentioned, it's not like single family where you're having to see what did the neighbor sell their house for. You literally have a whole lot more control just based on what you're able to do. So, from a value add, or from, what do you look for in a property in order to assure that you can add value for your investors and increase that NOI?
Yeah, that's a great question. Whenever we're looking, especially the markets that we're looking at is mostly cash flow markets, right? So a lot of what we're trying to do is look for places to add value straight from the beginning, you know, because for your listeners who maybe aren't familiar with how commercial real estate's valued, because that's important. If you buy low and sell high, then you as a partner investor, if you were to jump into, one of Keith's opportunities, right? That increase in value, just like a single family home increases in value. When you sell or refinance that, you become a direct beneficiary of that. So that's why it's important to know how properties are valued. And some of the things that we look for is we look for tired landlords, right? We look for landlords who just don't want to do it anymore, right? And usually what that means is we look at some of their financials and we see like expenses starting to creep up over time, well beyond the expenses that we have in our existing portfolio, or whatever we think our experience leads us to believe is too much. That leaves some opportunity, because net operating income is income minus expenses. So either you increase the income or you decrease the expenses, or maybe you do both of those. And that's going to do really well for your investors. It's going to increase the value of the building. So expense control, like that's one of the major things that we'll look at, right? We'll look at whether or not the expenses seem high. Then we're going to be looking at, whether the market rents for some of the units that are in there are low. Like, we feel that they actually should be higher, so people are not paying as much, right? And we could clearly identify why, right? Because sometimes they're smaller square footage, so that's justified, right? Or sometimes, there's no amenities compared to the properties next door. And then the other thing that we look for is what is the standard amenity in that area and what can we do to shine, right? So we'll look for, places to install dog parks maybe. Or we can look for washing machine ads, right? Or we can look to implement a rub system, which is like a utility bill back to the tenants for them using water. Really small little value adds that add up over time. There's even some, like it's crazy on the B class properties, Keith. Like if you go and install those little power plates that have USB plugins, right? And you install those, it's been shown empirically that through property management companies that those units command an extra $5 to $10 per month more because of those that are installed there. So that is a really, really cool little trick. You spend, 30, 40, 50 bucks maybe to grab two or three of those and just plug them into each unit. And over time, you're really gonna make out well, just by installing stuff like that one time, right? Um, and then we also look for major, like moderate to major types of work that needs to be done. Like if a roof needs to be repaired or if one of the buildings was damaged by a fire, then usually that means there's some level of distress. And we're willing to roll up our sleeves and do it because we have a boots on the ground team that's got construction experience and property management that's not afraid of it and wants to have that upside, right? We have the teams built out that are built to find and identify and make sure that those properties end up running great in the end.
Yeah, that's perfect. And what about, you mentioned property management. Are you using third-party property management or do you have property management in-house?
Yeah, that's a great question. Right now, we are not large enough to have our own property management, although that's where we're headed. In our 3-year vision, we want to make sure that once we cross the 1,000 unit threshold in a single market, which is, in our 5 to 10-year plan, that we're going to vertically integrate and start to have our own property management team in there to give us more control and visibility on our properties. But for now, what we have is we've got a tech dashboard, or we have these really cool things that I've enabled, which we can talk about on the time freedom, that about, right? Where it basically pulls the reports from the property management statements that come out, and my VA takes the information and highlights it all, right? And then drops it into a spreadsheet that's pre-populated that's looking at all these cells. And once they drop it in a certain way, I get instant report and visibility on our KPIs. How are we doing on our vacancies? How are we doing on our NOI? How are we doing on our turn times, right? And as we have all those things, that gives us a good opportunity to talk face to face in real time with live data with the property managers, with the third party property managers in our meetings that we have every 2 weeks with them. So it takes some time to find the right third party property managers that are willing to work with that much data and be, that tracked and measured. But once they do, if they're really on the up and up, right, and they really are trying to improve and they're good members of your team, then that's what you want. And people that refuse to do that, then they're not a good member of your team. They don't want to improve. That's someone you don't want to have anyway. So yeah, to answer, long way of answering your question is that property management is the lifeblood of what we do, and we track and measure everything they do. And it is third party. Yep.
Okay, perfect. And that's great. I think it's really neat that you got real time basically with the VA providing that data that you can share with the investors. They can see exactly where things are. That's fantastic. I think in these times, over communicating is super important. And I want to talk a little bit about these times because things have changed a little bit from when we had dinner in Austin. The market has done some different stuff. The rates have gone crazy, and there's a little just a total shift. And just want to kind of hear from you, kind of some of the changes that maybe you've seen, some of the adjustments that you're making and you and your team are making because of the change in market.
Yeah, it's been interesting. I think that this is long overdue, and I'm glad that we're doing something like this because it beats the alternative of the whole market imploding. So, there's going to be a lot of pain in the commercial real estate sector right now, or it's going to be coming soon, just because a lot of these loans that people took out are not achievable anymore. And so when people go to try to refinance or need to sell, there's no one to sell to because when loans that people can't afford loans because the interest rates are too high, so the loan payments are too high, and so you can't borrow as much money to pay the exits that these people who are holding property now want. So the market is shifting in a very interesting way right now. And thankfully for all of our investors, we have fixed rate loans, right? We didn't have to worry about buying a cap. We don't have any of that. So we have our rates locked for the next 3 years. And so we have plenty of time to kind of increase the net operating income to give us some more exits if we so desire to do that in 3 years. But the market is shifting. I still think there's plenty of demand, which is great for multifamily. And it is still something that banks want to lend to. So that's another plus for multifamily. But the increased cost of lending is bringing us now back down to like a normal level. Like we were drunk before, but now we're kind of on this hangover right now at this point. And so my opinion is, and I would love your thoughts on this too, Keith, is that an operator or an investor right now that can find a property that makes sense with like maybe a half a point or 3/4 of a point of debt baked into the assumptions, right, for acquisition. If you can find something now that meets that criteria and cash flows for investors, go for it. I think that that would be an amazing play. Otherwise, I think right now, buying into a market and then with the cost being so high to borrow, you can't use the same metrics that you were using before a couple of years ago because those loan products aren't around anymore. So if you can find something that makes sense right now in the high interest rate environment, in the next 2, 3, 4 years, eventually we'll start seeing loan costs decrease and the interest rates decrease. That will speed up the economy to allow you to have a better exit, whether it's a refinance or you're trying to sell the property. Because when loan costs are low, then sellers can pay more for your property for when you sell.
Yeah, I think that's great. Great observation there. I mean, when you go to buy something right now, if it like you said, if it cash flows and it makes sense at today's higher rate, it's only going to get better. As the rates finally start to come down, provided that you're buying it, price wise at a good spot, of course. But
Yeah, and that you're buying it with fixed debt too, because there are people that buy variable, and maybe in the next year or two or in the next 6 months, maybe it makes sense to buy a variable because if there's clear indication that the market will not be able to bear more rate increases, or if the Fed says we're good with inflation now, then maybe it makes sense to buy a variable because then you could profit from the downside, of it going down.
yeah, makes sense. No, that's good, and I think you're right. You mentioned that it's kind of it's time that we've done that before the market implodes. I think you're right. I think the pricing coming back down to a realistic number. I mean, for a little while there, the cap rates were getting so compressed, and it was just like, really, this doesn't make sense. And it forced a lot of folks too to make some assumptions about rent growth that probably were, realistic at that time. But now, things it's gotten a little harder to increase the rents and kind of build that into the underwriting where you're gonna have to assume that rents continue to go up at the track that they did here a couple of years ago.
That's another thing with the underwriting that I think most operators should be doing, which is what we do. We underwrite no rent growth in the first couple of years whenever we're looking at a property, especially in this environment right now, because you just can't count on that, right? Unless there's a forced appreciation play where that if you go in and you add countertops or you do you redo the floors, that you're going to get higher rents because the place next door with the same square footage and same amenities is getting it, then that's okay to write that into your assumptions. But we're not looking for market rent growth at all in any of our properties for the first couple of years. Just because we don't think that that's realistic given where the market's at. So thank you for helping me remind me about that underwriting criteria.
Yeah, absolutely. Well, let's see, Derek. And then right now, you're mainly working on the investments that you have for your investors right now. Just really kind of fine tuning things. Obviously, being ready in case something was to come up that looked like an opportunity. But right now, and I guess one thing before maybe we get into that, I was going to ask you, what do you look? What's your perspective on debt right now as far as loan to value? A lot of times a couple years ago, folks would sometimes just be able to put together an 80% loan to value and, with 20% down. And, the more I talk to folks, a lot of them are going a little bit heavier on the down payment in order to just make it a little bit less leveraged.
Yeah, I think I think that lenders are starting to become more strict. Before, Keith, like we were at a point where I could get a bridge loan at a 1.25 DSCR. So for the listeners out there, DSCR is a lot like the loan. It's like the DTI ratio, right? Like your debt to income ratio when you're buying a single family house. Like they want to see how much income you're making per year versus how much debt you're taking on, and there's a ratio there. Well, the same exists with multifamily property, which is DSCR, and that's the debt service coverage ratio is what it stands for. But basically, if your income doesn't it cannot go below 1.25 of the debt payment. So for instance, if the debt payment is $100,000 a year, then you better make sure that your NOI is 125,000 or higher. Otherwise, they won't write the loan for you because it's too risky for them. If your debt payment is exactly the remaining NOI, that's nervous because then there's like, what are you going to do if you get behind a few months, right? Like it's just you're not going to catch up. So this DSCR is changing in the eyes of the banks. They're now like bridge lenders are now going up to like 1.5. So in the commercial realm, even if I wanted to get out more loan to value, if I wanted to bring out more debt on a property and raise less capital and give more equity to fewer people, it's just not, it's the banks won't allow it because they're up to what's going on. Like it's very wise of them to know, because if you want to buy a $10 million property, they're a partner with you for 6 to 7 million, right? Just them. And so they want to make sure that they're protecting their capital and protecting their interests as well. So I would say that, being smart about debt right now is probably the main strategy that you can master to become a real winner in this cycle right now. If you can master the debt by maybe picking up an assumable loan, maybe there's a property out there that has 8 years left of a 4% interest loan, right? Then that property is great. Like you're good from the debt perspective for a while, but here's the catch. Most likely the sellers know that. And so they're pricing that in already, like they're pricing that in how much they want you to buy it for. So obviously more cash is better. But at this point in time, I just think that being responsible with debt is the best strategy. Bring as much cash as you can and then overfilling yourself, giving yourself more reserves. Twice the capital reserves that you think you're going to need for capital improvements is always going to work out better for you. And then you can always return that capital to your investors later. That's what we've done too, is we usually over raise. And then what we'll do is we'll return capital back as we see the whole, rehabs unfold, right? If they're ahead of schedule, or if they come in cheaper than possible or cheaper than we think, then we'll go ahead and refund some of that money back in the first year. So I think that's a more of a respectable approach rather than having to go to the investors for capital calls, right? Which is actually a pretty common thing nowadays with some of these investments out there.
It is. It is. You're hear a whole lot more about it now, and I agree. I think coming in with more capital than needed is a good perspective, because at the end of the day, anytime you're taking on a project, you're going to do your due diligence ahead of time, but there are surprises that you didn't see coming, and you want to obviously minimize those as much as possible, but to have a little bit of extra capital in case something is needed, I think is important. So
yes, absolutely. Yep.
I want to maybe shift gears just a little bit, Derek. I want to hear just a little bit more about, when we had dinner in Austin, you and Sophie were about to leave for, I want to say it was 6 months, but maybe it was longer than that. But going to Japan, you have really kind of built a life around being able to travel, and that's awesome. So I wanted to, number one, congratulate you for that, but also I just want to hear a little bit more about some of the adventures that y'all have gone on.
Yeah, no, thank you for that. Like one of the three pillars that we that we talk about a lot in, with our company and with our lifestyle is location independence. And the location independence thing was inspired by COVID. Once COVID happened, that's when the doors kind of opened up for us. But you're right. I think, when we were sitting down in Austin, we were getting ready to go to Europe, and actually we were supposed to be going to Japan that year, but Japan had closed their borders, so they weren't allowing any foreigners to come in without a whole bunch of visas, and even then it was really, really difficult. So we just like, we're not going to even deal with that. So we pivoted and we ended up going to Europe for 4.5 months or something, and we hit a whole bunch of places. We were in Portugal for a while, in Greece. And then, we went up to England and Norway and Iceland. It's just a really great experience, really great trip. And at the same time, we were still able to work, Keith. That's the cool thing, right? Is that, both my wife and I, we both have businesses. And so we're able to continue to do what we wanted to do while we were working. And, as we talk right now, my wife and I just came back from Japan. We finally made it to Japan. We were there for 3 months. We started in like late March and just got back in very early July. And it's been incredible. Japan is one of those places that they basically have everything figured out. We didn't want to leave. When we came back to the US, we were greeted with a long line in customs and rude people at the airport. And we're like, yep, welcome back to the United States. But in Japan, like, the food is incredible. The people are super friendly, even if it's very hard to get to know them because it's just is what it is. Everyone is super polite. Everything is really well thought out and designed perfectly. And it's just an incredible experience. So if you listeners have not gone to Japan and are thinking about doing it, please do, especially as of right now in Q3 of 2023. The exchange rate between the US dollar and the Japanese yen is at near record level highs, in advantage for the US dollar. It's like 140 over 140 yen to $1. And so you can find yourself getting a nice big bowl of ramen for like $6, or an all-you-can-eat buffet for like $15. So I highly recommend that you guys make it to Japan, just because it's an incredible country and I really want to support them.
Yeah,
Anyway,
awesome. That's awesome. That's awesome. That's great to hear. As far as the exchange rate, we're always looking for new destinations to go as well. So, and let's see, what as far you say you've traveled, you've been able to work, but and maybe my memory is not serving me 100%. But didn't you guys also travel like either in an RV or something like that prior to?
yes, we did. We did. We didn't travel in an RV. It was a CRV. It was our
Okay.
Honda CRV.
Okay. There you go.
And but basically what ended up happening was we sold our house during COVID in the California Bay Area, and we just reduced down to like 6 pieces of luggage, right? Like just our clothes, toiletries, and our computer equipment. And then we just drove around the country with all of that, living in Airbnb spaces. And we found out that when we were living in the Bay Area, it was costing us like $12,000 to $13,000 a month just to live, right? Between our mortgage, food, and transportation, and just all the stuff that comes around being a Californian, right? Like taxes, property taxes, things like that. When we left and we started going mobile, we found out that we could live anywhere in the country for less than half of that really nicely. Like you take $6,000 a month, $7,000 a month, and you go to Indiana or down to Texas, right? And you've got yourself a really nice lifestyle with that, right? Even being in Airbnbs, not to mention, being in a rental situation, like an apartment or something. And so we kind of took that to the extreme and realized that, like, when we got our location freedom, that's one of our pillars, all of our expenses went down, even though our passive income was at a certain level. Like we were at, in order for us to become financially free in the Bay Area, we needed to get like around $20,000 a month passive. And we weren't nearly at that level. But as soon as we went mobile, Keith, all of a sudden we became financially independent because we weren't living in an expensive part of the United States, right? Didn't pay the taxes, didn't pay any of that. And we were able to travel and just like kind of see the world and get to choose where we're going to stay and how long we're going to stay and where we're going to go. So really what it is, it's about taking your life and living it intentionally. Because when you live this lifestyle, it's like, okay, where to next? You know, because the Airbnb is running out in a couple of days. So where are we going next, right? And so you have to be super intentional. And we've kind of learned from doing this for a couple of years that you have to have a plan and a long term plan. And you kind of go to events, and on the way to the events, you kind of like stay at places along the way that you've wanted to visit. And so it's been a really cool adventure. My wife and I have just had a blast doing it.
Yeah, that's really neat. It's something that definitely we're wanting to do more of for sure. How about let's talk maybe a little bit about the pillar of time, and kind of regaining some of your time back.
Yeah, this is another thing that just kind of folded out of necessity. Over time, we have had to, as we've been traveling, you know, you don't want to be in a place where you're just taking your desk and you're moving it to Portugal, right? And you're working the same hours there and you're stressing yourself out, right? We realized early on that we have to build systems that scale in our internal business processes. So we have specific ways that we conduct business, right? We use Slack, Asana, ChatGPT now a lot, Notion, Loom, Zoom, all of these really cool tools like Otter and everything that we bring in along with Google tools and Google Suites and CRMs and stuff like that allow us to basically do our job within 3 hours a day, right? If we had to do normal operations, it would take us an average of maybe 10 hours a week to do the functions that we need to do in terms of real estate, right? Because we have everything so dialed in. So if we're looking to, for instance, operate our 6 apartment buildings or 7 apartment buildings, right, that have syndication aspects to them. Well, we already have an agenda that's already preset. We already have our metrics that's pre-populated because it's coming in from data that's live populated, right? And inside the meeting, this is just an example, right? Inside the meeting, we have Otter switched on, which means it's transcribing and recording everything that we say, that everything that the person that is talking with us, our property manager, the other team members, everything that they're saying. And as we talk, we're talking about things that need to get done. And Otter goes in and it creates action items. And so my VA can go in and see those action items, and then he drops it into the Notion page. And then that's one of the first items on the agenda that we look at on our next meeting is, did those things get done that we talked about in the last meeting? And so you can see that having these systems in place where all you got to do is just talk and follow up, right? And then having well-defined processes for someone who's working behind the scenes for you to present that information in the right way, at the right amount, at the right time, and in the right place, you can do some magic, right? Otherwise, I mean, just think through your day. Like, most people spend an average of maybe 3 to 4 hours a day in administrative stuff, not really actually doing things, but tracking it to making sure that you're actually doing it, or planning it to do it on a future date. And so we've just kind of evolved past that now. And now all we do is work on processes and growing the processes every time there's a new thing to do that comes into our business world. So I don't know
Yeah,
if that
that's
helps a lot, but that's the time freedom piece, right? Is like, if you can shrink the amount of hours that you work in a day for it to be 3 hours or 2 hours, you could even do that in your home right now. You don't have to be locationally free to do that. That's why we always tell people to pursue each of the 3 layers of freedom one at a time, right? Depending on what your
yeah.
needs are. So time is a big, big one.
Yeah, that's awesome. I actually inadvertently connected with Otter. So the last 2 Zoom meetings that I've done, I've gotten the transcript and everything. That's been pretty cool. But
Right.
I'll need to find out at some point how to take it a step further, like you had mentioned, and creating those
Yeah.
tasks and that kind of thing.
There's even a way, like right now, what we do for our podcast, when we prepare for our podcast, this is just a simple workflow, or a sample workflow, right? We have our guests fill out a Google form, and the Google form, once people hit submit, it goes into a Google Sheet. Like, you can tie that so that all the results from, everything that people answers goes into a Google Sheet. Then I have that Google Sheet linked with another one. And in that Google Sheet, it instantly takes those values that the person who fill out the forms populated, that it populates in the other sheet. And then I have the ChatGPT API set up with Zapier, so that as soon as it pops up in there, it creates a summary and sample questions for me right in the Google Sheet, right there for me to do my prep. And the same thing with social media. It gives us drafts of everything immediately once everything is done. And so it's all of these little things, that you just need a little bit of creativity to think about, how can I automate these to really make it worthwhile? And then the second question that we ask is it worth the time to automate? That's the other question, right? Because you can build your own workflow to automate something, or you can buy a solution. And is it worth either of those two? That's a question to ask. And usually, if the answer is no, then it's something we don't end up doing, right? And so that's how we've been able to kind of make it work with our automations and scaling.
Yeah, that's pretty awesome. All right, well, you've piqued my interest there, so I'll have to reach out to you outside of the show and just see if you can set me up on the right track here.
Sure, absolutely.
And as far as some of those go, is there a specific one that you're like, man, I can't believe it can do this, or maybe give us some other examples of just something that's just really saved time for you?
Yeah. So, in general, I would say Zapier is probably the most robust tool. Have you heard of this one before?
No. Mm-mm.
Okay.
I think I've heard of Zapier, but I have no idea what it is. So,
okay. Well, Zapier, just like there's a tool just like it called IFTTT, which is if this, then that, type of thing.
Yeah.
But I think Zapier allows you to connect tools to each other. So, for instance, if a value in a spreadsheet in Google Sheet changes, right? Like, let's say you have a pull down configured in a Google Sheet somewhere and the value goes from yes to no. You can have Zapier looking at that sheet 24/7, every single second of every single day, and as soon as that value changes from yes to no, that's a trigger, and it can do anything on the other end. So it can send an email. You can have it send an email, or you can have it populate another thing on another sheet, or you can have it send a Slack message somewhere, or you can have it, populate a task in Asana, or you can have it start a Zoom call. Like, there's all of these amazing things that you can do with this basic structure of trigger and then action that Zapier allows you to do. And so it connects all of these different apps together. And so it has to be something that you're using internally, but if you're using it for workflows to try to do some, social media posts or podcasting or whatever, something that's fairly complicated, you can do some pretty crazy stuff with Zapier. And it's a very, very easy and intuitive software to use after you test it for a little bit, right? But I highly recommend that people look into that only after you start thinking about what it is that you can automate in your business that needs to be just streamlined and done on its own. And then the other thing that I would say is Loom. Loom itself is a pretty amazing tool. Are you familiar with Loom?
I'll tell you what I know of Loom. Loom, you can record, like if you were trying to teach somebody how to pull a report for you or do something, you can actually record your screenshots and everything. And it's a time saver from a training standpoint, but I'm sure it does a whole lot more than just that.
Yeah, well, so you can use it for different things. Like, I use it to send out birthday greetings to people. And the great thing is here, this is probably a little bit of a hack I probably shouldn't be sharing, but you can record, like, I do batches of like 30 birthdays in one sitting, and then I'll use the Gmail delay send feature to basically just schedule it to go out on their birthday. So
that's
you
awesome.
have the recording done, and then you just have it send out, or you can put it in the CRM. It's just one link, right? And you can have that scheduled to go out anytime, but the recording is all completed. So it's very cool tool. And then the last thing that I will mention is, you mentioned it too, is Otter, right? The power, like, it doesn't seem like it's much, but it can take any video that you have and turn it into written word. And once you have it in written word, now you have access to ChatGPT, Bard, and some of these crazy things that you can do. So, for instance, if you want to do some social media posts, right? What's to stop you from taking a Loom video, right, and scrolling on social media and saying, "Oh, I love this graphic. This is great." And then you talk about it for a couple of minutes, right? Then you scroll to the next one and like, "Oh, this one's good too." Talk about that for just a few minutes about why you like it, and then scroll down and keep doing that for like maybe 5 or 10 posts, right, on one Loom video. Then you take that Loom video, you give it to your virtual assistant and say, "I want you to run my talk or my speech on the post that I like through ChatGPT and create a post like that, and then take the graphics that I was looking at and then redo it. Like, take the graphics that I was looking at on the screen and then put our logo on it, change the colors, remake it, right? And then
Yeah.
take the text from what I was talking about on that post and use it to create the infographic and create the post text using ChatGPT or something else. And then you can come up with a batch of like 5 or 12 posts based on 10 minutes of your time. Of
That's
course, it's going
incredible.
to way more time for your assistant, right? Because they're going to have to process all that data. But once they get really good at doing that, and they've done it a few times, just like what we've had with my virtual assistant, right, and my assistant there, it'll save an immense amount of time for you, right? And that's just a matter of like managing their work to make sure they have enough work to fill their plate. So that's how you can use those tools creatively. And if you have Otter, you can make that link between, having the video to getting the audio and then transcribing it to words, and then using the words in ChatGPT or Bard to make it sound more appealing. And you can kind of twist the tone of it and however you want to play with it, right? So that's what I would recommend doing. Those are just a few time-saving hacks that we're using all the time.
Yeah, no, that's incredible. It really is. It's just a whole new world to how you can run your business. So that's
For
fantastic.
sure. Yeah.
Let's see. How about maybe I know we're running maybe just a little bit long on time, but just really quick, I guess, from a financial standpoint, from that pillar, what are some things that maybe somebody who's just starting out, maybe they're working corporate and they're trying to somehow be able to either replace their income or, what are ways that they can possibly do that?
Yeah, great question here. I always recommend that people pay attention to investing and just know that it's a long-term game. Like, as long as your eyes are opened up now, if you can stick with it with some really hard goals for the next 5 to 7 years, you can eventually get yourself away from your full-time gig. At least that's usually what I've found to be an experience, right? It takes people about 5 to 7 years if they're leaning into it actively as an active real estate investor, and they start doing this on the side. If you're going to start doing it, as a passive investor, it may take a little bit longer, but it still, is very quick compared to, waiting for 40 years, working for 40 years, right? And
Right.
going down that path. But I think that, networking and becoming a student of the game, asking yourself what makes sense for me. Some people, they like to do notes, they like to buy debt, right? Some people like to partner up as a passive investment with operating, with apartment operators, or with self-storage, or with office, or with industrial or retail, right? Like different types of real estate. So if your passion is in real estate and you know that you like it, you want to get into it, I would recommend looking at single families from a distance, right? And trying to get as active as you can. But if you know that your time is limited and you like what you do as a full-time job, but you just want to get away from it and have a family and stuff, I think that passive investing is probably the best way for you to earn equity over time, right? Because you'll get the appreciation. You won't have to pay taxes on any of the profits that come in, even though you'll have cash in hand. And so I think that's the wisest way to do that. Plus, you'll learn the business a little bit from an operator, given that there's someone that wants to teach you. So given those things, I think that just sticking with it and having an investment plan, making sure that whatever goal it is, whether it's to save $50,000 or $100,000 a year to invest in syndications, if you can keep doing that and you buy 1 or 2 syndications each year, eventually that wealth is going to start snowballing because, within 5 to 7 years, those properties should be selling and hopefully doubling your money. And so as you do that and then continue to roll properties in, I think within 2 cycles or 3 cycles of really working hard, you should be in a great place, very, very easily be able to retire. So depends on how aggressive you are, but I would suggest just setting a goal that's achievable to you and what you want to do.
Yeah, I think that's great advice. Let's see. I've got a couple other questions for you, Derek. But first, before we go there, why don't we start with where people can find out more about you?
Yeah. So the easiest way to find out more about what we're doing, is to check out our podcast, which is at elevateequity.org/podcast. And there, wherever you listen or watch podcasts, it's all available. And then I would also say too that if you want to find out more about whether or not you're ready to invest in apartments, there's 5 forms of equity that you need to build, or if you want to do it on your own, there's 5 forms of equity. And so you can find out more about that on our lead magnet. Just go to elevateequity.org/podcast gift. And then there's a free PDF that's interactive. And it's a really cool thing that my wife and I put together.
Awesome. Okay, cool. All right. Well, a couple more questions if you have just another minute or two. And we've kind of covered one of them. But, as far as somebody who is just getting started out with their investing career, any tips that you could tell them that you've learned over the years that have helped you and Sophie?
Yeah. I'll try to make this quick. There are 4 C's when it comes to running any business or starting any venture up, right? There's consistency, clarity, coaching, and connections. And what I encourage people to do is pick one of those 4 things that you are most naturally aligned to. For instance, I'm someone who likes structure, so consistency was big for me. So I would show up in the office 1 hour before everyone else showed up, beating the traffic and working on real estate while I was working, right? Working my full-time job. So I showed up and did the work early before anyone else showed up. And I was consistent. Then what ended up happening was clarity. I ended up becoming really clear about what it is that I wanted with the real estate. Then I started getting a coach, and then I started meeting other people, the connections, right? So, and I've talked with many people about this. You just need to pick whatever one of those C's that most fits you, right? Maybe you just really you like to visualize stuff. Maybe you set a really clear goal and you can see it in your head, then everything else will start to follow. Or maybe you're invested in a network of people. So maybe connections comes first, and then all of a sudden you start getting a mentor, and then your mentor demands that you spend regular time on this, which forces you to be consistent. So all 4 of those C's will eventually come in. So just pick one of them, right? That you really that you can work into and lean into that, right? And just do that. And then eventually you'll start to get to where you want to go.
Yeah, that's great advice. All right. One more. And that is just if you have any book recommendations, anything that you've read recently that has just really been a good one.
Man, there's so many good books out there. Although I think I'm going to go with something that's a little bit different. Maybe, I'm going to say Cyrus the Great. It's one of these books about ancient wisdom, kind of along the lines of The Richest Man in Babylon, that type of thing. But Cyrus the Great, a lesson on leadership, and I think it's just a great book about how being generous it's really important for everyone. And I just really admire great people like that, where trust was not really a common thing, and people made that vow and ended up getting so much power and so much wisdom. And same thing with, Meditations with Marcus Aurelius. If you're into Stoicism, I think that's also an amazing book. Everything that we do in business starts with the mind. And so if you can tame that, then I think the whole world is kind of, malleable to your means. So those are the 2 books that I recommend a lot, is always start with the mind and the mindset, that then everything else pours out from there.
Yeah, absolutely. Well, Derek, I sure have appreciated our time together here today. It was great to reconnect with you, and I think you've provided a lot of value for the audience, for myself as well. So thank you so much for being on the show.
Thanks for having me. This was a blast. I loved coming on, and looking forward to coming on next time.
Yeah, absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.